Dwight Aakre. Dwight is Farm Management Economist with NDSUCREC Extension Service. Just asked Dwight when he started his career, if it was here in Carrington, and yes it was, and it was in 1984. So Dwight's been around for a long time, and sorry, please, he was able to join us today.
Okay, I'm going to go through a PowerPoint first of all, and then we'll take a look at the spreadsheet decision aid that Andy Swenson has put together. And then last we'll wrap it up with a very brief look at an additional spreadsheet that looks at alternative payments, alternative ARC payments under ARC payments under alternative yields and prices. I'll get it right. This farm bill is kind of 3 stages. There's the update stage, the election stage, and the enrollment. The update stage is updating your payment yields and reallocating base acres. That's open now. That ends February 17th, so don't miss that deadline. The election is the choice between ARC and PLC. That goes until March 31. And again, don't miss the deadline. If you do, you're out of luck for payments for 14. And there will be payments for the 14 crop. And then after that, there's the actual enrollment where you sign a contract. This time, we're going to sign a contract for 2014 and 15 at the same time. That'll be sometime after March 31st. The update portion, the reallocation of bases and update of yields, it's a one-time opportunity. It stays with the farm not only for the life of this farm bill, but beyond. And it's a great opportunity, I think, for all of us to take a look at what we have and how we can improve the yields and or bases. The yield update is straightforward. It's something everybody should look at. You do it by crop, by farm unit. So you might be able to update the yield of a given crop on one farm serial number and not on another. You have an opportunity to update them all, but you will always get the higher yield. So there's no way you're going to be hurt by updating payment yields. You get 90% of the average production, average yield that you've had over the last, over the 2008 through 2012 time frame. 13 doesn't count, and you don't get the full yield, you get 90% of it. That updated yield, if you choose to take an updated yield, will replace your current counter-cyclical payment yield that was in effect under the last farm bill. The yield, whether it's the old one or the new one, will only be used to calculate PLC payments. And the way it is used is if you enroll a base in PLC, if there's a payment for, let's say it's 10 cents a bushel, then it's 10 cents times your payment yield times your base acres times 85%. So obviously getting a higher yield is going to be worth it if you enroll in PLC. But you should all take a look at it, even if you intend to enroll in ARC, because it stays with the farm into the future. I've worked with farm bills since the late 70s. There's never been a farm bill that didn't utilize payment yield in some shape or form. And so if we have another farm bill after that, after this one, assume that yield is going to be important, and you ought to take the effort to get it done right. Here's just a quick example. I don't want to spend a lot of time on it, but a farm with, here's 5 different crops, 5 different existing payment yields. Obviously, you got a payment yield if you have a base. Then the history of the plantings over the 5 years. And here's the average for the 5 years. In this case, there's only, corn was only planted 3 of the 5 years. You're not hurt by those years when it's not planted, because you're dividing by 3 in that case. The others are divided by 5, sunflowers divided by 2. This is the average of these 5 years, or 3 years, or 2 years, and then over here is 90% of it. I circle the higher up because you will get the opportunity to keep the higher yield, whether it's the old existing payment yield or the new one. Everyone should go through that effort. Hopefully it'll be as easy as this. This is a printout from the state FSA office. It's some producer in North Dakota, I don't know who it is. Our FSA and RMA, FSA has written a program to capture yields that have been reported to RMA over this period of time, summarize them, And in visiting with CDs in Trail County and Steele and Steele and some other county this morning, they said that isn't available yet, but they're still hoping for it. And so we should be able to get that. If you get this, this makes it very simple, because here you have each farm, or each insurance unit number, and you have the yield for that farm, for that individual insurance unit. If you want, you can use the average yield for all of these farms, or you would have the opportunity to break it down by individual farms. So hopefully this will be made available in time, and it can make this process a lot easier. Now, the base reallocation, that one is not quite as simple. Everybody should look at it. Not every farm should be reallocated. Some should not. And the bottom line is going to be which bases are going to, do you feel will serve you better for the rest of this farm bill. And really with base reallocation, because it stays with the farm, you should be thinking beyond this farm bill as well. And so you have to think seriously about losing a base or part of a base and gaining something else. You can keep your existing bases. That's one option. The other one then is the reallocated bases. You don't have any choice on how they're reallocated. You made that choice unknowingly in 2009, 10, 11, and 12, because that's what it's going to be based on, what you planted those years. We didn't know that it was going to come back and help us or hurt us in the future. But that's the bottom line with reallocation. Here's an example. This farm had a wheat, soybean, barley, canola, and sunflower base. During the 4 years, the yield update is a 5-year time frame, 2008 through 2012. The base reallocation is a four-year window. During that period of time, wheat and soybeans were planted every year. Corn was planted 3 of the 4 years, barley 2 years, canola every year, and sunflower was not planted at all. So then the math, and you don't have to do this, the spreadsheet, I'm pulling this off of Andy's spreadsheet. We'll simply do the math. I've added a column here, but you average across, you get the average plantings of each crop over that 4-year time frame, and the total plantings of that, or the average planted of all covered commodities over that 4-year period is 850 acres. 412 of it is wheat. That divided into 850 gives you approximately 49%. That percent multiplied times your old total base acres will give you the new base if you choose to reallocate, and it would drop to 364 acres. You cannot increase base under this process. You won't lose base either. All you'll do is change the mix. So now you have a choice. You can take this column or this one. There's still 750 acres of base, but if you choose to reallocate, this producer is going to lose 120 some acres, or more than that, over 160, 70 acres of wheat base. He's going to gain about 50 or 40 acres of soybean base, but he's going to create a new corn base that he didn't have before, lose much of his barley base, greatly increase the canola base, and lose the sunflower base altogether because he didn't plant any. So you have that choice, one yellow column or the other. Which will serve you better for this farm bill and into the future? If you were in a area, and some of you might well be, where your bases are primarily corn, wheat, and soybeans, and you've been planting a lot of corn and a lot less wheat, reallocation is definitely going to work for you. If it's more mixed up than that, or if the increased acreage is probably soybeans, and you haven't increased corn, it's not an easy call. There are differences in the value of these bases, but the biggest problem with it is we don't know, the value of those bases is going to be determined on future prices and future yields. Anybody know how to predict those accurately? If you can, you'll have no problem with this decision. But if you can't, it will be a struggle for some. Next step here, the next thing I want to cover is kind of the meat or the heart of this farm bill. This, the election process where we make a choice between a price protection type of safety net called price loss coverage, or a revenue protection program, agricultural risk coverage. The difference being ARC, agricultural risk coverage, includes yield. The PLC does not factor in yields. Yes, your yields count for determining how big your payment is, but whether or not there's a payment at all, yields don't factor in. If you choose ARC, then you have an additional option. You can have it based on the county or based on your individual farm. I'm going to spend the time talking about PLC and ARC county, and for the most part ignore ARC individual. I think it's a lesser choice in my opinion. That's my bias. I think most of you are going to be more pleased with ARC county and PLC. A number of reasons, but one of the most important one is you can mix ARC and PLC by crop on an individual farm. If you go ARC individual, that's it. You don't have the opportunity to use PLC and obviously not ARC county. So I'm going to concentrate on the first two. The deadline again, as I said, was March 31. Don't miss it. There will be payments for some crops, some of them quite large this first year. If you don't make this decision by March 31, you're out of the program for this year. After this year, 15 through 18, the farms will be defaulted into PLC, so it's better than nothing, but you won't have the ARC option at that point in time. What's needed to trigger a payment under either of these programs? Well, with PLC, it's very simple. The price has to fall below some level. The level of that triggers that price is the reference price. It used to be called target prices. We've had target prices around for a long time. If the market dropped below that target, there was a deficiency payment. Prior to that, there were some other names for it. Now, there is a potential price loss PLC coverage payment if the price for the given commodity drops below the reference price. Those reference prices are an increase from the old target prices, and I'll show them to you on the next slide. Yield of any kind doesn't enter into the calculation as to whether or not a PLC payment is going to be made available. It is strictly responsive to price. ARC, on the other hand, either county or individual, includes the same price, but it also includes yields. And there's a benchmark that is the reference, so to speak. Reference is probably a poor choice of words, but the program creates a benchmark based on the last 5 years marketing year average price, Olympic average, so it drops the high and low and averages the other 3. Same thing with the same years for yield, so you come up with a benchmark revenue. Then if the current year's revenue falls more than 14% below that, that difference to a maximum of 10% of the benchmark is the potential ARC payment. For ARC county, it's that 5-year benchmark yield or price and the 5-year county average yield. If you go ARC individual, it's your individual farm yields. That probably sounds more attractive. But when you do that, all crops are pooled together on the farm. And typically you're going to have variability in performance of crops. So a good crop could offset a poor crop and you end up with no payment at all. Whereas if you had a good crop and a poor crop and the county was poor in terms of the average yield, it could trigger a payment for that crop under ARC county. In all cases, you have to have base acres. This farm bill isn't going to pay you a nickel for anything you plant in the next 5 years. There is no reference to planted acres in determining your payments. It's all determined on base acres. So if you have base, if that base is eligible for payment and you enroll it in that particular program, you will get a payment, whether you planted that crop or not. You can fallow your entire farm if you'd like for the next 5 years, and if there's bases on there and you enroll them and they trigger payments, you'll get them. So it's totally tied to base acres, nothing with what you do on the farm. Now, as I said, PLC, it triggers a payment if the market price drops below these reference prices. The reference price is set in legislation, It is fixed for 5 years, so it will not change. And if the current year's marketing year average price drops below any of these prices, it will trigger a payment for PLC. Yields don't come into play. It's $5.50 for wheat, $3.70 for corn, $4.95 for barley. That one looks pretty high. Previous farm bills have referenced feed barley price. More like, in most cases, well, it's going to be below corn price most of the time. This farm bill now goes to all barley, so it's a weighted average between malting prices and feed prices. We have changed in our production of barley in this country. Basically, we've dropped productions considerably, and what has fallen off is the feed barley component. Now, about 2/3 of the barley production in recent years has gone for malting. Consequently, previously that all barley price would have been closer to feed. Now it's going to be closer to malting. So I think that $4.95 is not quite as attractive a reference price for barley as it first looks like. Not saying it isn't going to be. In fact, I'd still encourage PLC as a choice for barley, and when we get to a spreadsheet, you'll see why. Some of the other soybeans, $8.40, is the soybean price going to fall below $8.40 the next 5 years? If it does, it'll trigger a PLC payment. If not, there's no PLC payment for it. The other one I want to draw your attention to is minor oilseeds. It applies to canola, sunflower, safflower, mustard, flax, and there's one more, I'm not sure what it is. And the one that really stands out is canola. 19 years USDA has been tracking national average marketing year prices for canola, and only 2 of those years has it been above $20.15 a hundredweight. So the odds are certainly in favor of it triggering a PLC payment, and certainly this year it looks like there will be a significant PLC payment for canola. Sunflower, flax, a little bit like that, but not quite as obvious. Now the ARC, as I said, that takes into play yields. So it's revenue that is going to, a shortfall of revenue will trigger a payment. So you have the same marketing year average price, but then for the ARC county, you have to look at how the county's yield turns out for this year. The benchmark is the starting point, the ARC benchmark revenue. That's the average, the 5-year average, Olympic average county yield times the 5-year Olympic average price. That gives us a certain dollar value. Then this year's yield times this year's price gives us the current revenue. You compare that to the benchmark revenue. If it's at least 14% less, then there's a payment trigger to a maximum of 10% of the benchmark. There is that 14% deductibility, if you want to call it, or shadow loss that is not covered. But then the ARC payment kicks in at 86% of the benchmark, and it ends when the revenue falls to 76%. Maximum rate then, of course, is 10%. This table can be somewhat misleading, but it never stops me from using it. The most important thing is right here at the bottom that you probably can't read. If the 2014 county average yield is exactly equal to the 5-year benchmark yield, then we can make an inference of what price will trigger a payment. The first column is the 5-year Olympic average price for these crops that's going into the calculation for this year. They're known, $6.60 for wheat, $12.27 for soybeans, $5.28 for corn. You look at corn and soybeans. Very good starting point for this program for corn and soybeans. Those are record high, I know they're record high 5-year interval prices, but we have in the 5 years that made up this $5.28 for corn, 2 record prices out of those 5 years. Soybeans, I think probably number 2 and 3 in that time frame. So we've got very high prices. That's not true for wheat. We've got okay prices, not great. So the starting point, the benchmark for wheat is not as attractive as it is for corn and soybeans. Barley, again, we've got that issue with changing from feed to all barley price. Oats probably is not going to trigger any payments under this farm bill. Flax also has, like soybeans, has a very attractive starting point for ARC. Well, now then, if we make an assumption that the county yield this year is exactly equal to average, then this is the price that will trigger a payment under ARC. If you have a higher yield in the county, it will take a lower price than this column to trigger a payment. If your yields are below average, it will begin to trigger a payment above these levels. So $5.67 for wheat. Over here is the latest estimate. That's actually not the latest. This should now be $6. Just a few days ago, USDA came out with their update for December. They're projecting $6 annual average marketing year price for 2014 wheat in the U.S. That being the case, unless your county has a significantly lower yield than the county average, don't expect an ARC payment for wheat for 2014. Soybeans, on the other hand, USDA is projecting $10. That one has not changed. It's been a 10 for a few months. And the 10.55 would trigger a payment if you have an average yield. But that's only a 55-cent margin. If you had 105% of average yield, that payment won't be there either. Corn, on the other hand, that will be there. $3.50 is what USDA is projecting. $4.54 would trigger a payment with an average yield. A county can have a yield average of about 130% of their 5-year average before that payment disappears. So there's going to be some payments for corn, and many counties are going to get the maximum possible. Barley, probably not. $4.69 if we have an average yield. $5.15 is what USDA is projecting for this year. Oats is well above the $2.80. Flax is getting close, but it's still projected to be above that point, which will trigger a payment with an average yield. These are the crops in hundredweight or pounds. Canola, $16.40, it will trigger a payment at $18.56 with an average yield. Don't count on it, because I don't think there's going to be many counties in the state that have an average canola yield. Much above is going to be the reality, and therefore there probably will not be an ARC payment for canola. But that yield does not impact the PLC, and with that kind of a price, there will be a big PLC payment. And so I don't know if I've got an example. Typically the counties where I've run a canola example, that payment figures out to be $38, $40 an acre. Per base acre for canola. If we have, I was actually using 17 cents, now they're looking at $16.40. So canola will trigger a large PLC payment, very likely. Then after you've made that decision, then of course you're going to have to sign a contract to participate in, I guess here it is here, 2014 and 15 at the same time. I think there's a good possibility that the payments under this farm bill will be the greatest the first couple of years, maybe 3 years. We could very well have lean years the last couple of years for payments. If prices stay about where they're at for the next 5 years, I'm not predicting that, but if they are, we will have ARC payments early on for several crops. A couple of crops, as I said, will trigger PLC payments. And if prices stay flat, anything that triggers a PLC payment now would continue to trigger it. But ARC, that benchmark, keeps ratcheting down. And by year 3 or 4, the benchmark will have fallen to the point where the same revenue as this year will not trigger a payment. So that's something we have to think about. You make an election, you choose ARC, PLC, and it's good for 5 years. If you had your druthers, you'd probably take ARC to begin with and switch in year 3 or 4, but you can't do that.
In all cases, the landowner has the final say.
Okay, that's a good point. The landowner is the decision maker for yield update and base reallocation. The operator, the producer, has the decision for ARC, PLC decision. If it's a cash rented situation, then the operator makes that decision for the ARC, PLC. If it's a share rental arrangement, both the owner and the operator have to agree. I'm going to bring up a couple of spreadsheets, and that might clarify some of these points a little bit better. This is the decision aid that Andy Swenson has put together, and some of you have used it already, there's other decision aids out there. Other universities have them. There's 2 web-based ones that USDA funded, University of Illinois and Texas A&M, to develop web-based tools. And they're very good. I'm not going to knock them at all, but they're a lot more complex. They include everything. They put everything into it. This program is much more streamlined. It looks at yield update, base reallocation, ARC county, and PLC, and that's all it looks at. It doesn't look at SCO, it doesn't look at ARC individual, it doesn't include the dairy program, the MPP program, and everything else. I think there's a NAP buyout that's in some of those others. So this is a simple one. Andy has put these spreadsheets together for a number of farm bills. He's very good at shrinking it down to really the key issues that we need to use to make the determination. And so I'd certainly encourage you to use it. And by the way, you can download this at this website, ag.ndsu.edu. And I would check back periodically to see if there's a newer version on it. I'm guessing we're pretty well done with it. But he did just about a week ago put a newer version on it with some updated prices. And that can help in your decision a lot. If you, or when you do download it, you've got to identify, if you're all in North Dakota, you'll want to obviously bring up North Dakota. Minnesota is in there as well, so you'd want to obviously get the state right. But also it's important that you identify your county. And there's, if you hit this box, it'll bring up a drop box and you just pick the county. The reason that's important is because there's historical yields embedded in this program for each county. So you don't have to look up all the history of the yields for the last 5 years for your county. It's all here. Once you bring up, in this case, Foster County, it'll bring up the yields when you get to that table. There's 4 tables then that you need input. The first one is to take a look at base reallocation. That's all this table is going to be used for. Well, I shouldn't say that. It enters into the ARC PLC decision, obviously. But in this case, I looked at the historical data for Foster County, put together a so-called representative farm. It has 500 acres of wheat base, 55 of soybeans, 30 acres of corn base, 65 of barley, 160 of sunflowers out of 1,000 acres. Total base of 810 acres. Then we've got our planting history for 4 years. If you have prevented planted to any program crop, that should be entered as well because that counts as planted for base reallocation. Any non-program crop doesn't get included here at all. These are only program or covered commodities. Then the program does the math for you, but it calculates the average plantings. So we've got our 2009 through 12 average, and then it takes and calculates the old base was 810 acres. You're going to end up with 810 acres of base. In this particular example, the plantings were less than that. That's irrelevant. If this particular farm planted 10 acres of corn in 2009 and followed the rest of the farm and followed it the rest of the years, they'd end up with 810 acres of corn base. How odd is that? But that's the way it works. So once the program does its calculation, you're going to end up with 96 acres of wheat base if you choose to reallocate. Quite a change. You want to give up 400 acres of wheat base. It will increase the soybean base from 55 up to 453. And I can tell you right now, there's not a lot of benefit and not an obvious benefit of soybeans over wheat. Maybe a little bit, but it's not intuitively obvious at this point. Corn, 30 acres up to 233, that's a clear winner. Barley base, 65 drops to about half, and the sunflower base disappears completely. So now you have a choice. You can either stay with what you had, or you can go with the reallocated basis. Once you make that decision, it stays with the farm for the life of this farm bill and beyond. The next table, The other thing that you'll notice on the previous table, the whole thing was yellow. Here now we only have yellow the crops that are in play. The crops that you either had original basis for or crops that you didn't have a base for but planted during this time frame. We had basis for all of these crops. The only thing we didn't do is plant any sunflowers, and so we have no yields. So I plugged in actually I looked at the historical county average yields and just plugged them in for this particular farm. So these are the yields from 2008 through 12. This would be for your farm. They are going to then be used to calculate a new payment yield. And in this case, we won't spend time, but here's the existing payment yield. Here's what you'd end up if, with the new yields. 44 would be calculated, new yield obviously better than 30. But in the case of soybeans, it does go up. I guess the last county it went down. Corn goes up considerably from 63 to 106. Barley goes up from 44 to 64. And sunflowers can't change because we didn't plant anything to prove a higher yield. So then you would get the higher of these yields. FSA is going to automatically give you those higher yields. Now is where you'd really do the guessing. The first two tables were historical. This is the historical yields for Foster County. Again, when you identify the county, it brings in those yields. And then we have to project the county average yields for the next 5 years, 14 through 18. What I did for these yields it's the Olympic average rounded off of the previous years. But I don't know which years are going to be better than average and which are going to be poor. If I did, I'd rent out my land in those poor years, but I don't know that, so my luck would be a good year. So I just use average yields across, and again, you need to make your judgment on those. If you think you want to use something other than average, feel free to do so. Then the last table brings in prices, and again, from 2013 and back, it's historical prices. Most of 14 is, obviously they're not historical yet. So 14 through 18, we need to project the prices, and it's not your prices, it's not futures market, it's not posted county price, it's the national average cash marketing price. These are the numbers that are in the spreadsheet right now. They're the default numbers. You can run with those or you can change them. Where did they come from? The 2014 prices are the latest projection from USDA, came out last week. They're projecting that the wheat price for 2014 crop is going to average about $6. $10 for soybeans, $3.50 for corn, $5.15 for barley, and so on down. The other years, 15 through 18, come from FAPRI, the Food and Agricultural Policy Research Institute out of Missouri and Iowa. They have been in the business of projecting future prices for a long time. Now they have gone to projecting covered commodity prices for these 5 years every month. They're updating them every month. So if we get we get on their website, you can get on, just Google FAPRI. You can find that web page. If they make a drastic change in any of these prices, I think that's unlikely, but if they do, more than likely we'll put a newer version on it and change those prices. But they're suggesting wheat is going to drop to $5.35 annual average next year, and then slowly increase through 2018. Same scenario for soybeans, drop to $9.10 and then increase to $10.25. Corn, they're suggesting it's at its low point this year at $3.50, and then will rise slowly, but again, it's pretty flat after next year, rising to $4.10. Barley, on the other hand, fairly high this year, but dropping to $4.60 next year, and kind of hovering in that $4.60 to $4.80 range throughout the remaining 4 years. And all of these prices are below the reference price, therefore it would trigger a PLC payment each of those 4 years, if that's a realistic price. And the other crop we've got in play here is sunflowers, and here's what they're projecting, falling to 18 next year, 19, basically 19 and a half after that. So that's the input that's needed. Now let's take a look at the results. This is the summary table. It brings it all together. It looks at the results if you stayed with existing base, or if you went with reallocation of base. So the table is split right here. And the one that is green is highlighted as the better of the two, obviously. And the bottom line is the most payments. In this one, and he's also calculated the first year payments under either scenario and the 5-year total under either scenario. If we stayed with existing base, the first year, 14, we'd get about $2,300 off of this 1,000-acre farm. If we went with reallocation, $18,000. It doesn't impact anything you do on the farm, so why wouldn't you go with that reallocation? Doesn't change any of your costs at all. Under the 5 years, it's not quite as extreme. $31,000 for the 5 years. Under existing base, $59,000 under the reallocation of base, total for the 5 years. The other thing it shows you is that ARC is the selected choice for soybeans, for corn, wheat. There's no wheat payment in the first year, but there is somewhere down the line. And PLC for barley. And sunflowers, there's not there in the reallocation, but it is there under existing base, and then PLC would have been the better choice. You want to see what the payments are by year, by crop. Here they are under existing base, under reallocation of base. You can see, look at wheat in 2015, a $9,800 payment for ARC, $2,800 for PLC. Obviously, you don't get them both, it's one or the other. And the previous table just pulled the higher up and put it in the summary. And so you've got all the crops that are in whatever color that is, are the ones that are being calculated in this spreadsheet. Then the real detail comes at the bottom. And everything from this bold line to the left is needed for calculation of the ARC county payment. This calculates the PLC payment. We're looking at wheat the first year, no ARC payment, no PLC payment. Does look like a pretty significant ARC payment in years 2 and 3, and then nothing after that, and no only PLC payment in year 2015 when we used a $5.35 price. The price has to drop below $5.50 in any year to trigger a PLC payment. A little bit of the math. $6.60 is our benchmark price for this year. Next year will be something different because the first year will drop off, and 2014 will enter in that 5 years to calculate the average. 52 bushels is our average yield, Olympic average yield for 14. Depending on what the yield is in 14, it'll change for next year. But if you take $6.60 5-year Olympic average price times 52 5-year Olympic average yield, you get $343.20. That's the benchmark for this year. ARC payment can be no more than 10% of the benchmark, or $34.32. The payment will be calculated by subtracting current revenue from the benchmark. Well, the current revenue at $6 price and 52 bushel yield yields 295, yields 312. Our guarantee, which is 86% of this, is 295. Therefore, no payment. It's out of the money by almost $17. But you see in year 2, the actual revenue 278, the guarantee 321, and so the shortfall is $23.15. That would be your payment per payment acre, but he's put it over here in the next column is your payment per base acre. So I take this one, this figure times 85%, because that's the acres that we get paid on. That's wheat. Quickly looking at soybeans, it suggests that there could be ARC payments the first 3 years, no PLC payments any year, no ARC, this will be the last 2 years. You'll also notice here it says maximum ARC payment rate in year 2015, $33, the maximum it could be. And then the next year it drops off to less than half with the same yield, slightly higher price. Again, our benchmark is starting to fall. And if we look at corn, a a little bit of a PLC payment this year, but the maximum payment available in 2014 and 15 would be the projection with an average yield for corn for this year and next year. Then it drops off dramatically in 2016, no ARC payments the last 2 years. And you can see it's a maximum payment in both 14 and 15. Barley would trigger PLC payments every year except this year. Again, Fabry's prices seem to me maybe just a little low, but if they're right, it will trigger a PLC payment after this year. Very little for an ARC payment, so I think barley is a PLC choice. And the other crop that was in play was sunflowers, but we didn't grow it. But that would trigger PLC payments. And again, it doesn't matter that you didn't grow it, but if we reallocate base, we lost that sunflower base. But if you would stay with the existing base, it will trigger some PLC payments. Sunflowers this summer I have seen ARC triggering better payments, so that one is kind of a toss of corn or soybeans. I think this is the type of scenario that could very well play out with this farm bill. Prices hovering about where they're at or rising very little, falling very little. We're going to lower that benchmark so that by years 2017 or 18, maybe even 16, there will be very little ARC payment. That's certainly a possibility, I think, that could come out of this farm bill. But remember, they have to get below the reference price to trigger anything under PLC. Corn, I think, is an ARC crop. Soybeans, I think, is an ARC crop. Wheat could go either way. Barley, I think, is PLC. Canola, definitely PLC. Sunflowers, flax, probably go either way. You need to run the numbers. And the other thing is you need to run this spreadsheet or do this analysis for every individual farm unit you have. You can't combine them, because that's not the way the payments are going to be calculated. So you have to look at each individual farm serial number on its own. Now, at this point, I've really concentrated on response to price, and certainly that's a big factor because it's the only factor for PLC, and it's half of the weighting for ARC. But yield is extremely important, so I put together another spreadsheet I want to show you very quickly. I've got 4 different tables in here for 4 different crops. You could substitute barley for wheat if you want. The label here, barley in Foster County, don't have any impact on any calculations, but the 3 yellow blocks up here do. The 5-year Olympic average yield for Foster, or market average price rather, for everybody in the country for this year is $6.60 for wheat. The Foster County 5-year Olympic average we saw on that last tables of the last spreadsheet is $52 or 52 bushels. USDA's latest price projection is $6. So then in this matrix, the $6 gets pulled down here to the left-hand column. In the middle, I put it in red. The 52 bushel yield gets pulled out into the middle on the top. And then I graduated yields up in 10% increments and down in 10% increments. And the price up in 10-cent increments up to $6.40 and down to $5.60, I think is at the bottom. And then it'll simply calculate the payment under those alternative yields and prices. Obviously, the payments are going to be stacked on the lower left, and to the right and higher up, higher prices, higher yields, the payment disappears. In this case, the maximum payment for Foster County wheat would be $34.32. We know that today. What we don't know is how much of it we're going to get. If the county average is 52 bushels this year, forget about a payment. There won't be any. Unless the market price drops to $5.60, USDA is currently projecting $6. So an average yield for wheat in any county is probably not going to trigger a payment for wheat. The wheat yield in any county must drop below that county's average to trigger a payment, and even down 10% isn't going to trigger much of a price if we end up, or much of a payment if we end up with a price above $6. Get down to 6, it will trigger in Foster County about a $14 payment, and then of course it gets larger. Again, that maximum kind of runs at a diagonal, yeah, right here, goes right on down. So you got to get down to an 80% yield. My guess is most counties have an average or better yield for wheat, and consequently not likely to receive an ARC payment in 14 for wheat. Soybeans looks a little bit like it. 12.27 marketing year price, 31 bushel yield, $10 projection for this year. So here's our 10 and 31. Maximum payment is 38. Again, an average yield. If we have a price above 10.60, or we have, well, even a little bit less than that, above 10.5, it's not going to trigger an ARC payment. Well, it's actually 10.55 if you remember from the previous PowerPoint. But if we get below that, and USDA is now at $10, an average yield will trigger about a $17 payment, and if the price drops more, it will be larger. But anything above an average yield, for the most part, is not going to trigger an ARC payment. Corn, on the other hand, is a little different. 5.29, that 5-year benchmark price, 113.7 is the benchmark yield for Foster County, using a 350 projection. Even at the average yield, you get the maximum payment of $60.15. What's the average yield going to be in Foster County for corn this year? Most counties I've been in, they say it's going to be above and sometimes well above that 5-year average. I don't know what your yields are. They will come out probably in February, and so we'll hopefully know that before we make that final decision. But even if, again, this being the average, if you have 125 bushel yield, we still get maximum payments anything below 360, and significant payments up here. 120% of average to 136 bushel yield, still payments anything under 370, and maximum down here at 330, 320, and 310. Get out here at 147, 48 bushels, no payments unless we drop down below 350. So corn is the one that is going to trigger some large payments. I don't have canola on here, but that would be, I got sunflowers. Canola, that yield being way up here in this range would wipe out the ARC payment on canola. Sunflowers, kind of the same thing. In fact, the less than average yield is going to eliminate the ARC payment for sunflower. That spreadsheet is available at the same website. You're welcome to download it. You run the ND spreadsheet first, and then pull out that 5-year Olympic average yield and price, plug it in for your county, and see what kind of a potential range of payments you might have.